today, and that's going to be buying puts. Oftentimes, when we're doing these presentations here on the trading strategy desk, we cover the wide gamut of option strategies that are available to traders. And we've gotten the feedback that it'd be nice if we could spend some more time on a single strategy and do a variety of those sessions. And that's what we're doing here today. So if you're someone who has a lot of questions about buying puts, maybe you've heard of that, but you're not exactly clear on what that strategy looks like, what it means, some of the implications, this is the session for you. I left up the calendar for everybody just for a moment there. So if you had a chance before the session started, you are, of course, welcome to take a look at that here. But we're going to hop into some of the slides, get our introduction and disclosures covered, and move forward from there. So this is buying puts, what you need to know. There's a few different disclosures I'll roll onto the screen right here. One of our older presentation decks, but of course the information is still relevant, still very current here to modern day trading. Keep in mind, folks, if you need closed captioning for any reason, that is going to be available for you. We'll do our very best to speak clearly and slowly, but we always know that some clients want that feature. In addition, for this next hour we have together, we will do our very best to keep this a conversation as opposed to maybe a dissertation. So we don't want to talk at you, we want to talk with you. So if you have any comments, any questions, let us know, put that in the Q&A. James and myself will be monitoring it throughout today's presentation, and we really do look, and we'll do our best to answer your question. Last thing on that note real quickly as well here is if there's a symbol that you would like us to use as an example, today we do have some pre-made slides that we're going to cover, but we're also going to do some live demonstration. So during that live demo portion, if you want us to use a stock that you're interested in, maybe you're trading yourself, you've been eyeing on your watch list, go ahead and put that in the Q&A as well, and we'll try to incorporate that into our examples. And then just a quick high level goal of this session here, now that we've taken care of some of those disclosures, is we do want to make clear to folks, why a trader might buy a put. And what are some of the key considerations specific to this strategy, aka why would you choose a specific strike price? What are some of the pros and cons that come along with it? How about expiration selection? Do you go shorter term? Do you go longer term? What's the good and the bad with that? Option Greek review. So this is going to be, when we think about option Greeks, those tend to be more of an intermediate term or intermediate concept. And so for anyone who's never heard of those, we'll do our very best to speak in layman's terms, but we will talk about option Greeks to a certain extent. And then just lastly, as we're going through all these different topics, we do our very best, not just with buying puts, but really, I think any strategy of what are things to be aware of, right? What are some of the pitfalls or common behavioral finance characteristics that we see in ourselves or as traders through the times that we've spoken to them that we want to make you aware of. So, James, with that, I'll pass it over to you to just maybe start us off with, what is the strategy? What should we know about it here? What does it mean to buy a put? But good to see you.
Good to see you as well, Chase. And yes, this is a beginner type of session, so we do want to start at the very basics for those of you that are really still getting used to various option strategies. But in this session, more so in most of our option strategy reviews, because we have that full hour, we'll get to really dive in some of the intermediate topics, which really is the Greeks. That's oftentimes what we kind of use as that maybe defining line between going from beginner to intermediate. So when you start to take the Greeks into consideration for your trades. But starting with just the strategy in of itself, a long put is going to be constructed simply by buying a put to open. It's as easy as that. Doesn't entail more than going on your options trade ticket and going on that single leg trade and choosing buy puts to open. Unlike some other multi-leg strategies where you have to kind of construct a few together, or even something like a covered call, right, where you have to construct two pieces to create said strategy, it's nice when it's as simple as just going to buy to open and choosing that put. Now, when you are long a put, it's the same thing as being a buyer of the put or a holder of the put. Those are three terms that can be used more or less interchangeably. Again, buying a put, long a put, or holding a put, when it's just a singular put trade and that's all that you have, that's going to be the strategy. Now, the outlook for a long put on its own is going to be bearish. That means you're thinking that whatever it is you're trying to get exposure to, whether that be a single stock, an ETF, an index, you're expecting that to go down within a defined period of time. And when we talk about bearish, that is meaning the price is going down, not moving sideways, right? Of course, not moving upwards. But that's something to also remember because options are a decaying instrument. You could be bearish on a stock and short it, and maybe the stock doesn't go down right away. That doesn't hurt you. That doesn't kind of detract from your P&L. That's not the case with a long put. You are paying for that contract and it will lose value uh, just with all else being equal to the passing of time. So you want to make sure that you're saving this strategy, this tool for those circumstances when you're expecting price to move down and you have a kind of a clear expectation of when you're expecting it to do so. It doesn't have to follow suit with what you expect it to, and then you may decide to close that trade, but that does need to be a part of your kind of outlook, both the direction and the time it's going to take to get there. And that's just only two of the three things you'll have to have an outlook for. Now, when it comes to your kind of maximum gain, fortunately, when you buy a put, the gain can be substantial. And that's oftentimes the word that's used to describe it. Unlike with a long call where your profit is theoretically unlimited, with the long put, it's substantial. It's the difference between the strike price less the premium paid and zero. So in our example, where we have a long 100 strike put that we're paying $3.15 for, well, what is that difference between, what is that kind of math, that strike price and the premium? So the difference between, right, that strike price and the premium, so 100, we can say minus 315, that's going to be 96.85. So that difference now between 96.85 and zero could theoretically be your substantial profit. Right? In this case, the most amount of money that a trader could make in this is 9,685. Not that it's ever really going to get that to that extent, but that is that theoretical maximum profit. Again, strike price minus the premium paid and whatever that difference is between that and zero. Your max loss, because it is a buying strategy, is just going to be your premium paid. It's fantastic, right? You know what the most amount of money that you can lose, that you have at risk as you get started with the trade. And this is, as I mentioned earlier, something that is going to be the biggest kind of benefit and oftentimes an acceptable trade-off to just shorting the stock. Where if you were to short, in this case, ABC stock here, instead of buying a 100 strike put on it, well, you could lose theoretically unlimited when you sell those shares short. Should the price continue to rise, and if you don't cover, you'll continue to take on losses. Your max loss is capped with the premium pay that you're paying, and that's going to be probably the biggest kind of benefit of choosing a long put over shorting a stock. But of course, like with everything in life, right, there's a trade-off. You may think, well, why doesn't everyone just short a put, right? Especially if you're not taking on the maximum loss, especially if you're bearish. Short a put, you don't have to worry about in kind of unknown risk. Well, unfortunately, that trade-off is that you'll need it to move more when you're buying a put as opposed to shorting a stock. And even if you're not ever going to consider shorting a stock, I like to compare and contrast them because those are the two most kind of common bearish ways to kind of try to profit on some type of stock, index, or ETF outlook. And that break even is going to be the kind of downside compared to shorting. That strike price minus the premium paid is our break even if we were to hold this all the way to expiration. So if we were to say buy this put for $3.15, we actually need to get all the way to 96.85 if we were going to hold it till expiration in order to get a profit there. And that's contrasting with just shorting, where if we shorted it at $100 and it went to 99, we're already profiting. And we know we're going to stay profiting even if it were to remain at $99. Now, a key thing to remember, break even at expiration is different than break even half the way there or break even a few days after placing the trade. And that's attempted to be illustrated in this dash line. This could be at any point in time, right? If you bought a put at 100 and you bought it for, say, 2 months out, and let's say the stock goes to 99.50, it just drops slightly. You may already be at break even or even at a profit at that point in time. The sooner you get the movement, the sooner you're going to reach that break even. Of course, with the furthest is going to be that 96.85 when there's all intrinsic value and at that point, no time value remaining. Now, there's one kind of other point we can mention here, and we can possibly talk about this later on because it is the discussion of buying a put shows time permitting. We might be able to talk about hedging, and that is if you're buying a long put, when you also have a long position, that is considered a hedge, and that is bullish. And this contrasts with what Chase and I, at least initially, going to be discussing here. And buying a put as speculation is bearish. So I'll say that once again. Buying a put to hedge is bullish. Buying a put to speculate is what's considered bearish. And there are ways that we can kind of evaluate that in our own account that we'll get to later. So when it comes to kind of buying a put, now that you know the construction, let's say you've already chosen the underlying, you know you're bearish, you have a time frame that you're expecting it to move. Maybe you're saying, I think it's going to move down in the next week or two. Great. You've at least satisfied two of the three outlooks, so you're majority of the way there. You go over to your options chain, and then you start thinking to yourself, oh, what do I do now? There are quite a lot of strikes and expirations. And we got a symbol here, so we can start with this. And that was going to be Costco, COST. So you go to your options chain, you're thinking to yourself, I'm bearish on Costco. I think it's moving down. Again, I haven't even have pulled up the chart here. So really we oftentimes need a chart to make that outlook. But we start thinking to yourself, okay, what's next? Got the underlying. I switch this from calls and puts to puts. We've got the time frame. Maybe in this idea, going with this scenario, I said, hey, 2 weeks. I think it's going to go down in 2 weeks. So what if a trader just decided to go out kind of 2 weeks in time, say 2.5, and choose July 12th? Uh-oh, there's a lot of strike prices. Well, what strike price should I choose? And this is, I think, going to be the kind of first step in going from that developmental phase of placing the trade to the kind of application and the actual placing of that trade. So that brings us to the question of strike selection. Now, not all strikes are created equal. There's going to be some positives and some negatives to the strikes. And your strike selection should also be based on, to some extent, maybe your kind of level of bearishness. How bearish do you truly feel? How low can you go in that stock? So right, we know when it comes to the reason the strike selection, we know the reason for the trade, right? We're trying to achieve a decline in price. And we now have to kind of weigh the cost versus the exposure. Now, you could say to yourself, I only am willing to commit such and such dollars, and that's perfectly fine. If you're saying to yourself, well, I'm bearish on this, but Costco is a kind of a pricey stock, but you say to yourself, I only want to commit, say, $300 to this position, nothing more. I'm very bearish. 300 is my max. Well, then it might make it fairly easy to find where you are on the strike price. But if you've got some flexibility and you're thinking to yourself, okay, I want to find the strike price that maybe matches my outlook best, well, we are going to have to weigh kind of the cost versus the exposure. Cost is going to be intricately linked to your risk. Why? Because your risk is based on the premium that you pay. So your risk and cost, again, are going to be linked to just how soon you might be profiting. So when it comes to all of these different strike prices that are going to be available to you, one thing that we can look at it, we'll talk about a few things that you're going to want to consider, I think, first and foremost. One, of course, is going to be that price. Next is going to be the delta component. And that is going to help us understand what our exposure that we're going to be taking on, just how we will profit for every $1 movement in that underlying, all else being equal. And that's what delta is. So for those of you that are new to the Greeks, this can be the first one that we'll discuss. Delta, sometimes it's viewed as almost like a share equivalency or a probability that it's going to be in the money at the expiration date. But at its simplest terms, it's just telling us how much we're going to expect that options contract to change in value per $1 movement of that underlying security. And that is going to be kind of a key component because it's going to tell you, well, okay, if you are right, how much money are you going to make? Is it worthwhile to choose this particular strike price if you get the move that you're expecting? Now, another kind of important component here, it's not highlighted, but it's this idea of theta. And we'll kind of talk a little bit more about that too when we discuss the expiration selection. But this just lets us know how much money that we would expect to lose just due to the passing of time. So with all those being equal, how much value will be kind of eroding from this contract. So to somewhat kind of summarize it, when it comes to kind of choosing your strikes between in the money, at the money, and out of the money, well, if you go in the money, so a higher strike than where it's currently trading, you're going to be committing more capital, taking on more risk, but also gaining more directional exposure, which is a good thing if it goes in your favor. Not so good if it goes against you. There's the at the money puts that have the, I guess we can say the kind of disadvantage of the highest time decay. It's less capital than in the money, so we could say there's less risk involved. There's less directional exposure, but it's what's referred to as the highest acceleration rate. I don't really want to go into it. It's related to gamma. What that means is that if it does start going in our direction, it's going to start benefiting us greater and greater. And then finally, out of the money puts, which, to be frank, are probably what the most amount of traders choose when it comes to putting on these strategies. They have the disadvantage of less directional exposure. So if it starts doing what you want, you're not going to be making as much money as the at the money and in the money puts, but the benefit is far less capital is oftentimes deployed. So these are kind of the trade-offs, like with everything in life, right? You're going to have to choose between, do you want this good with this bad, or this bad with this good? So as we kind of jump back over to our options chain, where we were looking at Costco, we can add a variety of different columns here. So let's say I were to add the column for delta that we discussed earlier. I'm going to remove just these others, just at this point, just to ideally keep it as simple as possible. And I'm a fan of keeping my option chain as simple as possible, focusing only on what you feel is going to be necessary for you, or what could be beneficial for you in your trade, where we can see all of the prices that are listed, the ask being really the one that we can expect to be at the most that we're going to have to pay to buy one of these contracts. And what this is telling us with Costco at 857, if we were to buy this 855, which is the closest contract that is at the money, we would spend $10.30. And if Costco starts moving down, let's say Costco goes from 857 to 856, because that delta is 44, we would expect this contract to make 44 cents, or for one contract, profits of $44 should start to, the value should start to increase by $44. Now, delta will change as the underlying continues to move down. We would expect delta to continue to rise as this goes from an at the money to an in the money. And we can see here how the delta changes. It's much cheaper to buy an out of the money contract, but we're only going to be making half as much value for every dollar decrease that we're seeing. And knowing that these at the money contracts, that acceleration aspect will start to grow their deltas faster and faster. So that's going to be one kind of thing to consider when it comes to choosing your strike price. And that is going to be the cost versus the directional exposure. Just to give maybe a kind of a trader's tidbit here, more often than not, when traders are kind of looking into do they want to go in, at, or out of the money, they can also just determine their level of bearishness in just how confident they are in the trade. And if you're very bearish and very confident, you might decide to go at an in the money put because you're going to start making money immediately there. But if you're still very bearish, but maybe not as confident, right? So we've got very bearish and confident, very bearish and not as confident. So you may not want to put that much capital in the trade. That's when you could go towards the kind of out of the money puts. That way, if you still see the decrease, you can still realize meaningful dollars and to some extent a greater degree of leverage because you're putting far less capital down when you go with out of the money contracts. But if you're not as confident, you're not putting as much capital at risk. So I would imagine most traders, if you're looking at buying puts, you should be bearish. You should be bearish to very bearish. If you're neutral, again, that's not really the strategy that is kind of that this is designed for. So think of your in the money versus the out of the money aspect of maybe your level of confidence in the underlying going down. So that's kind of one thing to think about when it comes to placing that trade, right? We already know the construction, there's the strike, but there's always, of course, one other question when it comes to expiration, the differences between expiration. Jays, I can let you talk about expiration unless did you want to continue on anything further on strike selection before we jump there?
I think the strike and the expiration kind of go hand in hand here, James. So I'll transition over to expiration selection. I'm sure along the way we'll talk about strike once again here. So let me pull up the slides for a moment. Now, one of the most common questions we get is, what's the best expiration, right? And I say best a bit tongue in cheek, but it's a valid question. I totally get why traders ask it, which is, hey Chase, should I be trading short term? Should I be trading intermediate term, long term puts? Like, what is the deal? What should I be looking at? There's a few things I want to talk about before we even get into the nitty gritty of the option Greeks, which is how long do you see yourself being bearish? I give you an example. If earnings are coming up, let's say earnings are in a week or two, right, for company X, Y, and Z, and you already have some expectations that the company's not going to do very well. So you're bearish in the near term. Well, do you need a 1 year put or a put that expires in 1 year's time to trade an event that's so short term? Likely not, right? You'll probably get a 1 month to expiration, or maybe give yourself a little bit more time and do a 2 month expiration option for a put, knowing that the trade is really based on a short term thesis of the company's going to have poor guidance, they're going to miss top line and bottom line estimates, and the stock's going to plummet. And so, for those reasons, you expect a short term movement downwards. And so, you're probably going to right size your expiration to that need. With that said, here though, if you have a longer term expiration of, hey, I'm kind of uncertain about the future for a quarter, couple quarters, then by definition, a 1 month option's probably not going to do you much good unless you're going to consistently roll or consistently do these short-term trades. And we'll kind of get into the numbers and talk about maybe if that makes sense or not. But I just like to start off here, James, and recognize that we might just be able to use logic to a certain extent to kind of back into the answer of what expiration makes sense. Now, the slides say, time frame, event based. I talked about that, like maybe earnings or an FOMC announcement. Now I do want to get into the more nitty gritty with the option Greeks for time decay. By a raise of hands, who's heard of this term time decay before? Whether it's in a session of hours, if you've read about it, I'd be curious to know who's familiar with that. Okay, so a number of clients. That's awesome. All right, good to see that. Let me lower the hands for just a moment. So theta is the option Greek that shows us a unit of time decay. In other words, how much can we expect the option value to erode or decay or lose value on a daily basis? Okay. So if we take a look here, I'm going to use Goldman Sachs as an example. This comes through from Jayashi. If I'm saying that correctly, I apologize if I butchered the name there. So Goldman Sachs, which is currently trading for 455 and change. So the 455 strike is close enough to being at the money for conversational purposes. If we go over here to the right, I've added theta as a column here. Again, James showed it, but just to reiterate here, if you don't have this column and you want it, you can simply right click on an existing column and choose add column. From there, you scroll down to the bottom and you'll see the different option Greeks. Now, it's not listed here for me because I already have it applied. But if you don't have it, that's where you would see it. So the 455 going across shows a theta of negative 0.2723. So how do you interpret this? Here's how you interpret it. The negative 0.27, I'm going to leave off the 2, 3. Those are just rounding super, super small, right? The way you read it is that this option, which has a bid and ask of $11 by $11.25, will decrease in value approximately 27 cents per day moving forward. Now, there's a whole bunch of caveats I want to unpack there real quickly here. The first thing is, this isn't going to be to perfection, right? Because that's an all things being equal statement. If the stock moves, well, then you have to worry about directional implications. If there's an increase of implied volatility or a decrease, if there's a change in volatility, that's going to affect the option. So we're just isolating. If all things are equal, then with the passage of one single day of time, we would assume the option, all things being equal, to lose 27 cents of value. So if the bid and the ask is 11 by 11.25, let's just say the midpoint for conversational purposes, just to keep my math simple, is like 11.15, right? Well, we're going to assume it's going to be 27 cents less than that, okay, by tomorrow. That's a very rudimentary way to think about this. Now, there's another caveat, which is that time decay is not linear as you get closer to expiration. It's more of an exponential or parabolic type of relationship. So the closer and closer you get, the faster and faster or the bigger and bigger theta becomes. Now, I want to show this in more detail here. So, James, I opened up a second option chain behind the scenes here. And now what I've done is I've selected just the 455 strike across a number of different expirations so that we're isolating for just the strike through time. And what we're looking at here, folks, is the theta across time. So what do we see here? The 23 days to expiration, the July 19th, has a theta of 27 cents. Okay. The August is 16 cents, then 11, then 10, then 7. Notice that that is not a linear relationship. It's not getting 2 or 3 cents more, 2 or 3 cents more, 2 or 3 cents more. It starts to compound. It gets bigger and bigger and bigger the closer that we get. Something else to note, however, is not only does the nominal number increase through time, aka the shorter expiration has a higher theta, all things being equal. But if we look at theta as a percentage of the option contract value, that's another way that we can think about it, right? So this is 7 cents. So we're assuming there's a 7-cent decline in option value per day. Again, all things being equal, simply due to time decay, on a $28.35 by 28.80 option. In this case, the spread is an order of magnitude bigger than this data. This data number is incredibly small as a percentage relative to the cost of this option as of now. However, as we start to get closer and closer, here's at 27 cents. That's going to be a bigger percentage of this option value. In fact, if we go into the weeklies for a moment, we'll choose here, what's the closest? The 28th. We'll see if this loads for us. So this option is $4.25 by 450. But look at the theta here now. It's $1.35 per day, right? So what is this relative to the current bid and ask? It's about 25%, rough math, right? So how do you read that? Well, if I was to buy this put and nothing else changes by tomorrow, we would expect at a minimum to lose about 25% value due to time decay. That's incredibly important for a trader to understand, and that's why I'm spending so much time on theta. So as we see this relationship through time, then comes the question, James, well, what am I supposed to do then? Like, what's better for me, or what's more appropriate for what I'm trying to do? Well, we can do a little bit of a blended approach. You could do something like technical analysis. We talk about this all the time on our different sessions. You might look at a chart and say, well, maybe based on this chart here, price action is underneath its 5-day simple moving average. That's that black line here. And I'm expecting it to maybe pull back and curl down beneath its red 20-day and come back down to the 50. Maybe that's your outlook for whatever reason, right? You're saying, hey, this short-term bearish movement, maybe I'm going to consider this to continue to roll over. Well, if we extend this line out through time, to the best of our ability, kind of a straight line from it. All right, well, when would this intersect? Assuming it kind of continues this movement down, this day on our calendar is July 1st. So in just a couple of days. Now, again, we're not predicting that this will happen. We're creating a forecast of what may happen. And that's what we're trying to develop our trade thesis from. Again, I'm using this as a very quick example. But let's just say this is the example you're using. Well, you know that July 1st is, if all things go exactly according to plan here, July 1st is that intersection, right? So we come back to this option chain. Well, where is July 1st? We've got a 28th. Well, that's probably going to be too short. It's not going to bring us right up at least to July 1st. How about July 5th? Maybe. Here, let's remove some of these other ones here for just a moment. We'll focus in on July 5th. Hold on, let me get rid of this January 1 there. Perfect. Okay, so what's our theta look like? Well, it's 36 cents. Or if you want to think about it in total dollars and cents, it's $36 a day. 36 cents of this $5.65 by 590. Is that tenable? Well, we're going to have to wait a few days to get there. So we're probably going to assume, okay, 36 cents times a few days. We're probably thinking of like estimating we're going to lose maybe $1 or $2 of time decay just to get to that day. Again, assuming no movement, but if it was to move, that would change things. But if it stays flat for those couple of days, we're losing $2, $3 of value just from time decay. That's probably more than 50% of the option. So if I go this short, if I go right up to about the day I'm expecting, really, really short, that time decay is going to be a huge component. So what do most traders that we speak to often end up doing is they'll try to buy themselves more time. They'll say, you know what, even though that's pretty close to maybe my expectation, gosh, if I'm wrong in any way, that theta is going to chew me up. So they might start to look out a little bit further. For conversational purposes, we'll choose the next weekly, and then we'll look at this August, and we'll talk about why. So this next weekly, while it's a little bit longer, it's got a little bit lower theta. Now, what is it before? Well, it's before the expected or estimated earnings announcement. So do you want to keep the put through earnings? Maybe, maybe not. If you do, then the next monthly is this July 19th. That would get you through the time frame of your technical forecast. It would also get you through the earnings, right? So now we can start to look between these two and start to compare and contrast. Well, this one, the July 19th, James, is twice the cost approximately of the July 5th. So what am I getting for twice the cost? Well, a lower theta. And theta, while it's only a couple of cents lower, as a percentage of the option value is significantly lower. So these are some of those trade-offs that traders are looking at here in real time, looking to make these trades. And I like using theta because it really does help you to understand what kind of time decay exposures that you have going into the trade. I will say there is no best though. Like if you were to call us and talk one-on-one and you said, hey, what's the best choice? We couldn't say like this is absolutely the best. Each one's going to come with its trade-off. Yeah, you get more time to let this trade play out, but you're paying up a lot more money. In fact, twice the amount as the shorter term. And if you have capital constraints, that just may not work out. All right, lastly here, James, I'll pass back to you to see if you have any additional thoughts here on theta or time decay and some of these expiration selection implications. Would be if I go back to this option chain, you may also just look at different strike prices to then see what kind of theta exposures you have there in addition to the expiration itself. So going back to that weekly option, let's say you look at the July 5th and 19th. Well, now you might look up and down the chain at the theta and say, okay, well, let's see if I go a little bit lower here, what's my theta? My theta is actually a little bit lower. Why is that? Because there's less time value in the option. So theta only affects time value. Okay, that's good to know. I'll take a look at this expiration. What does that relationship look like? Well, it's only 2 pennies cheaper if I go further down. Is that really worth it? Well, it's going to cost less. And so you can start to really do that comparative analysis from a trade perspective. I guess the last thing I'll just note real quickly here, James, is if you were ever in this scenario, and we can demo this if need be, but I want to give you a moment to talk, is you can mock up any of these opportunities in our profit and loss calculator. And that's often what I typically will do. So whether you're using this option chain, or if we come back to this one that we were just using, let's say you're looking at this to go a little bit further into detail. If you right click this action icon, I go down here to option analytics and then the profit and loss calculator. I can load up a theoretical trade for the exact contract we just looked at. And what we can do to better understand some of that theta or that time decay or that time passage concept is we could actually fast forward the clock without changing anything else. So don't change price. You don't have to change the volatility inputs. But if we just fast forward price here, let's just say to the 5th, right? What would that look like for our option? Well, on July 5th, if price stayed exactly the same, we're going to lose $256. Why? Because of time decay, which again, theta is trying to show us. All right, James, I went a little bit of a tangent there, going through why theta I think is important and how we can read it and understand it. Your thoughts?
Well, I like where you're going with the P&L. So I'm gonna continue on kind of your direction here, and I want to even throw in a few other examples so we can maybe kind of show what you were illustrating, but put mini contracts kind of into consideration, and we can kind of compare and contrast maybe the difference between kind of an outlook that someone could have and a variety of different strike prices and expirations. So jumping us into my Active Trader Pro here. So there we go. We're going to be taking a look at Apple. So I saw that you gave us Apple. I know you mentioned it possibly in another type of strategy that involves long puts, but I want to use it just for at least the speculation component first. So what we have down here are 7 different strategies. One of them being stock, but pay attention to the quantity. It's -100. That means it was shorted. So this could be, if I can open this back up again, when we're looking at our basis here on shorted stock, because when you sell something you don't own, You still have to pay it back at some point, but you sell first and then buy second. So in this case, we would have taken in a credit of 21,395. So a profit will be when the value goes down, shorting. Now I've got a few different puts here. I've sorted it by basis. So it's actually going from the cheapest to the most expensive. And what I've done is I've have two different strike price, out of the money at 200 and at the money, slightly in the money at 215. We can see Apple's at 215, or 213.96, just in case anyone's looking. So probably be 214 at some point during the conversation. So again, we've got two different strikes, kind of series of strikes. We've got out of the money and at the money. And then we've got three expirations, July, August, and October. What I did was just the next monthly, which is, what is that? We can call that 3 weeks, right? 3.5 weeks. So less than a month away. Then 4 weeks after that, so 1 month, and then a 2 month difference from August. We're skipping September, going straight to October. So we can see even more time in place here. And just by sorting it by my basis, I'm able to see that, right, there's some kind of sequence here, right? We're going first out of the monies. All of the out of monies are less expensive. Basis is just how much this trade cost. I'm taking at the current asking price. So again, I know there's a question between bid and ask. The bid is the price that you could sell it for. The ask is the price that you could buy it for, buy the option. So the ask price is what, to some extent, we're going to be looking at. These are fairly close differences, so just go with whatever the asking price was. You'll notice 60 to 12,395, so $60, $212, $395. All the 200 strikes are first, and the further we go, the more expensive it is. Should be make sense for everyone, right? As we go further in time for the same strike price, it's going to cost more because, well, contract is valid for a longer period. Then we go to the at the monies. All of the at the money contracts, even the shortest July, is more expensive than the furthest one out in October out of the money. And we can see the difference here. And then as we get to the at the money contracts, it's still that same idea. As we go further out in time, it's going to cost us more. Kind of an interesting thing to think about, right? We could buy all the way until October, right? June to July, August, September, October, just shy of 4 months for less money than a contract that's expiring in about 3.5 weeks. But of course, we need Apple to move quite a bit. And that's why I think oftentimes traders are somewhat, when they're looking at these, they're not really going in the money because they're bearish and they're looking to take advantage of the leveraging ability of options, but they still want to minimize their capital committed, minimizing the risk, because the risk and the capital are one and the same. So all of these out of the money contracts are cheaper, even going out 3 weeks. So you may say to yourself, well, if you're very bearish, how are these going to respond? So let's run a few scenarios. And I did include short stock because it's an option. Maybe if you're bearish in an IRA, like a rollover or a Roth or traditional, sure, you can't short. Another reason why long puts could be advantageous, because really tough to be bearish in an IRA without options. It can be done, maybe some inverse ETFs out there, but for the most part, options are going to be your friend in this. So up at the top, as Chase showed earlier, we've got the three kind of boxes to put our outlook in. The direction of price, how long it's going to take to get there, and the percentage volatility change. And in this scenario, what if we were, even though we're actually considering August and October, what if we thought our outlook is only that Apple's going to go down over the next 2 weeks? So that's June 10th. So I'm going to go to my scenario, my date here. Go to not June 10th, July 10th. Let's give it one more. Let's give it 3 weeks. So July 17th. If Apple didn't move, what contract should be losing the most? And what would we be ahead the most? I'm going to sort it by the theoretical profit and loss. So here's that advantage of shorting. Hasn't really lost, right? If it stays right at this price. Let's even say it just goes up a few pennies to 214. Hasn't really lost money. Interestingly enough, right? The July and the October have lost the least, but out of the money. The October at the money lost actually slightly less than the August out of the money. And this is kind of going back to what Chase was talking about in theta. That lower theta actually was the reason why that this October at the money contract is actually doing better for you. You're still at a loss, but doing better than the out of the money. But as you can see, if it does nothing, the out of the money contracts, because they have, not all of them, of course, but that kind of lower theta decay, that's why they're doing better if the stock does nothing. Very similar scenario here. If it was 2 weeks, just to show that example here, sort it again. Again, similar scenario. Going further out at the money somewhat helped you. All of them are in the red. At the money near term and at the money 1 month after were hurt the most. Now back to that 3 weeks example, because realistically nothing really changed here. What if we get a little bit of a move? Apple 213, 210 isn't much, but a little bit of a move. How does it look like now? Again, I'm going to sort it by our theoretical P&L. Shorting the stock has been in the most advantageous. The at the money contracts, because of that higher delta, we're able to capitalize on that smaller movement, hence the profits. The out of the money contracts, especially the near term, we didn't get as much movement. So this is that slightly bullish, and let's be realistic, $4 on Apples we can see on a $214 stock, it's a little less than 2%, right? So it's not a small movement, 2% in 3 weeks, but it's not really a large movement as well. But what if we got something like a 5% movement on Apple? So from the 214, so we're talking, actually we're talking maybe even a greater amount, so like we're talking maybe 205. So still not in the money. So we'll give us a little more room. How does it look in those 3 weeks? So again, to keep in mind, the at the money contracts did better for that smaller movement, where these really didn't make much of a profit. Let's go to 205. I'm purposely not changing implied volatility. That would absolutely be something you'd want to consider. But being still a beginner session, we can keep this somewhat out of the picture just to not complicate things too much. Fortunately, if stocks start moving down to even a greater extent, oftentimes implied volatility will increase, which will help the trader. But we'll kind of table this at least for the beginner series conversation. But still, I want this to really kind of sink in the idea of the kind of profits and losses. We get that larger movement, and it doesn't matter what expiration that you chose. Again, the at the money contracts are doing better. Now, there's also something else to kind of play into consideration here. Notice how the further out did better, both in at the money and at out of the money. We go October, August, July, October, August, July. And why is that? Well, there's really some of that kind of theta decay kicking in. Theta impacted these contracts far more in those closer expirations. So they lost a bit more of their value, especially those Julys, right? We only had 2 days left in those July contracts. Now, I've only been taking a kind of an outlook on this based purely on the dollar value. the percentage return is something I think that is worthwhile discussing, right? This top one, $419 with a basis of 925. So you've made 45%. Taking a look at that same October contract, 186 over 395, so $186 profit with a 395 profit. What is that? It's actually 47%. So still you're making similar kind of percent returns in both of these contracts, right? So yes, these values are higher, but the percentage return is still going to be similar. So this is why it's sometimes helpful to also to think not too further into it. And I'm a big fan of, especially as you're getting started, don't always worry about the percentage as much as just how much capital are you risking? How much capital are you putting in? And is the profit at least worthwhile for you based on what could happen? Now, these are on shorter moves. If we start to get maybe a substantial move in Apple, maybe like a 10%, a 10% move in Apple, where we go to say 195. I'm going to sort this again, right? Things start to get a little bit wonky now, right? Before that July contract was at the very bottom of those at the monies. Now it's actually at the very top of that profit and loss. So this is where those deltas really start to come into place. And not only does it have a higher profit, we spent much less on the Julys than we did on the Octobers. So what does that mean? We actually have a far greater return, right? $450, we've made 1550. So this is really why, when Chase brought up that question, when clients will ask us, what's the best strike to choose? What's the best expiration? What's the best strike? Well, no one knows. We won't know until after the fact that the best way to find the optimal strike, I could say the optimal expiration, is what do you expect to happen? And then we can find the right strike and expiration for that, knowing that maybe it's not going to happen exactly like that because we can't predict the future. But if it gets somewhat close to it, at least you should be comfortable with the profits that you'll be making. And this is where the closer dated were actually better than the longer dated, right? Back to 205, we get a smaller movement. It would have been right better to have chosen some of these even smaller here, right? Where we take into consideration, it would have been better to have chosen those further out for a smaller move. We start getting the larger movement to the downside. We flip it July, August, October instead of October, August, July, which is what we saw on those 215 contracts. But also putting it into percentages. Look at some of these out of the money contracts. And this is going to be why I did want to at least bring this up. If you're very bearish, this may be the smallest profit, but we spent $60 on this. So we're getting a 7-bagger here. We're over 7, right, 100% difference on this. Take a look at our 2000 or our August 200. Right, we're getting over kind of 100 right percent, 570 over 212. Well, I mean over 200%. So you can see from a percentage perspective, these trades can go quite far if you are right, despite being the lower value. So again, there's that kind of take. Are you looking at pure dollars or are you looking at that potential of return? And there's no kind of right or wrong. I oftentimes suggest newer clients to look at from that dollar perspective, even sometimes more than the percentage, because we don't want to we want to protect our dollars, especially when we get started on our trades. July, August, October, October, August, July. And kind of interesting, right? when we get that great move, at least from that pure dollar value, in this case, the highest dollar profits are the nearer term options when we are starting with at the money, but the highest profits are the further options or out of the money. We go October, August, July when we're in our out of the money strikes, knowing, of course, this is still going to be the greatest kind of percentage profit. So again, when it comes to what's your objective on the trade, are you looking to just make kind of real dollars, a certain kind of amount of dollars on this of profit, or are you looking for a percentage of profit? And you might think, well, hey, I'm looking for profit, but ask yourself, are you looking for more of, are you worried about that dollar profit or that kind of percentage profit? You may think, well, if you're expecting this movement and you're saying, hey, this $400, I am very much happy with $400. And you could then kind of risk far less, right? $60 compared to 925. Now, that's only if things go in your favor. Did, of course, want to talk about what happens if things go against your favor. We don't have to spend as much time because, as you can imagine, what was benefiting someone was also hurting someone. What if we have that slight rise in price? So Apple going from 214 to 225. We'll say we go up 10 points or roughly around 5%, all considering 3 weeks. Here we go. Well, here's our short stock. This is our, I guess we can say, our control study here, losing 1,100. Our puts, August, October, July, October, August, July. Right? Interesting here at the money, they're losing greater. This is where that higher theta and the higher delta is actually hurting them. The lower delta is benefiting us. We were less sensitive to those changes in price. Noticing that we have an almost total loss in this scenario on our July, but the total loss is, what is it? It's still less than all of our other options trades if we are wrong. So you may be asking yourself, well, hey, what if I want to spend, I'm still expecting it to move downward, say 200, and I'm fine with spending, say, $500 on the trade. Do you buy one, say, at the money July, or with that amount of cash, right? We could buy, say, 8, just to be somewhat kind of close here. Go 7. In this example, 420, 450. Now you're starting to kind of involve leverage. And just for that last example, I'm going to delete some of these simulated because I get this question from time to time and they say, well, I want to take more advantage of that ability of options to leverage, and that can absolutely be a advantageous aspect of them. In this case, I'm going to reset. Notice our P&Ls are minuscule here. We're both looking at July contracts, spending very similar, $30. Let's go out that 3 weeks it takes to get our movement to July 17th. If it goes against us, say 5%, it goes to 225. Similar losses, one may say. If it goes maybe exactly what we want, say 10% lower, 195. This is where that leveraging of the options takes place, right? We've got that same risk. So when it goes against us, we're hurt, right, somewhat equally, but the amount of profits that we can make even exceed, right, that stock, both in dollar terms and, right, in percentage terms, right? We're going to see both the dollar and percentage term profits when we start to use the greater leveraging ability of options. I wanted to leave that again as kind of food for thought there, hence why we've seen many traders gravitate towards shorter term options because of that leveraging effect that they have, but understanding if something doesn't occur, we stay at 214, right? We're still at a loss. Our max loss is equal, but we have much greater profit potential should we choose that. That leveraging ability that options have. So ideally, what this was meant to do, right, was just kind of show some of the positives and negatives of both the kind of differences in strike prices, the differences in expirations, and we got to show a little bit of the kind of differences between increasing your leverage with multiple contracts. Now, ideally, if you're going to start placing trades on puts going forward, use this tool. Give yourself in the same kind of exercise that we just did right now. If you're bearish on XYZ stock and you have that time frame, whether it's 1 week, 2 week, 1 month, 2 months, just play with some different expirations. Have some out the monies, have some at the money. Give yourself maybe at least minimum 3 different expirations and put in some of those inputs. Give different prices. Provide different expirations. What happens if you get the move in 2 weeks? What happens if it takes a week longer than you were originally anticipating? Are you comfortable with those profits and losses, and compare that kind of leveraging scenario as well? Maybe you'll use more contracts for these out of the money versus maybe that one contract for at the money. Are you comfortable with the break even that you need, with the moves that you'd be expecting, both positive and negative? And ideally, right, we can't predict the future, but what you can do is prepare yourself for those scenarios. So if you get a movement, you're not going to be wondering, oh, this happened. Why does my profit and loss look like this? Because the worst conversation is, and this used to happen all the time, both at Chase and myself, because we would talk about it, when traders would call us saying, hey, everything happened as I was expecting, but why am I losing money on the trade? That's when you're using this tool. Oftentimes that scenario is based on implied volatility. So even though it was left out because this was a beginner session, that is something that you'll want to consider. Hence, join us if you haven't learned to create an outlook on volatility. We do have our intermediate session for options. We'd like to absolutely invite you to join us then, especially we've got a new month coming up in July, so you can get started right from the very beginning. But we're already 3 minutes over, and I do want to be respectful of your time. I appreciate all the questions and comments that came in. Thad, I know you gave Apple for the long put as a hedge, but that even though, yes, it's a long put, it's a different strategy, right? So we wanted to still keep it long puts as the speculative strategy, not long puts as the hedge. But absolutely a good comment to bring in. Be on the lookout because we do have hedging sessions as well. So until next time, everyone, please be safe out there. Best of luck for any of you that desire to sling some of those long puts. And I hope to see you on another session, possibly very soon. Thank you, Chase, as always.